Welcome to Fixated, the Fixed Income Podcast. I'm your host, Elizabeth Moran, Editorial Director of Fixed Income News Australia. Join me as I talk about the latest news, views and education in fixed income investment. I'll be joined by industry experts from Australia and across the globe. Welcome. Today I have Dr Christian Baylis, who is Chief Investment Officer and founder of Fortlake Asset Management, back with us again about a year after we last spoke on inflation. Welcome, Christian.
Thanks, Liz. Thanks so much for having me.
So lots happened in a year, and I'm wondering, did 2022 play out as you expected?
Oh, look, I think, there were some parts that did, but clearly there was a lot of things that happened in 2022 that I think no one could predict. There was, obviously Russia-Ukraine would have been one of those moments. I think we spoke around mid to late January last time, which was right before the Russia-Ukraine war even started. So, I certainly wouldn't be claiming that as a prediction at all. So I think you had so many things. You had UK politics, you had Trussonomics, you had iceberg lettuce, you had US politics, Trump on the ballot for 2023, or announcing it, I should say. You had the Zeitenwende speech from Olaf Scholz in terms of, the scaling up of military assets, all those sorts of things. And you also had the capitulation of well-known economists such as Janet Yellen. That was one of the remarkable things, I think, of 2022 for me, was when Janet Yellen came out, I think, in around March or April of last year and said that she's got inflation wrong, and that ultimately, everything needs to be revised and we need to look at this another way. So some of those things were really pertinent points. We had record-breaking monetary tightening and a deep awareness of inflation. I think since we spoke, we obviously had social events like the Queen dying, all these sorts of things. It was a fascinating year. So there was very hard to say that you could have predicted all of that. I think you can only say it's about minimising your error around the judgment of those particular things and trying to navigate a path through it all. And certainly, I think, focusing in on the investment side, that's certainly what we tried to do.
You were one of the few asset managers that did extremely well last year, and congratulations on all those double-digit returns. But let's get to that in a little while. So in terms of inflation rates and interest rates, still with today's most recent 25 basis points increase, the cash rate is still way lower than the inflation rate. How do you see it moving from here?
Yeah, look, I think this is one of the really interesting points, and this is I think a polarising topic in the central bank world, at least, is that the way I see it is that obviously here in Australia we've got a 7.8% headline inflation rate, but really what's ultimately important is the trim mean, which is obviously the RBA's preferred measure. Now they've got penciled in 3.8% for the end of 2023. And obviously with that most recent inflation print, they're going to have to revise up that 3.8 to probably somewhere around 4.1. So when I look at where monetary policy is today, and we're now at 3.35, and we've got a trimmed mean inflation rate forecasted to be around about 4.1 at the end of the year, I just look at that and say that is nowhere near restrictive territory. And that's being generous using a forward rate that may not even eventuate. If you use ex-post inflation, i.e. if we roll forward 7.8%, which is pretty aggressive, I don't think you can justifiably do that. But even if you went somewhere in between that trim mean inflation rate and that headline level, you are still going to have deeply negative real rates. And I do not see a neutral real rate at being below 0%. And so if we've got trim mean inflation at around 4.1 and we've got a cash rate at 3.35 today, that just has to mean, to get into restrictive territory and to put downward pressure on inflation, that we have to move the cash rate up further, somewhere towards that 4% level. Otherwise, we're not being serious about restricting or dampening demand. I just really don't see it that way. And I think, I'm not sure what I said to you last year, Liz, at this time. Hopefully some of it was right. But inflation's going to have to really come down, and I think there's rose-coloured glasses on just chiselling out that last stub of inflation. I don't think the challenge for central banks is getting inflation from circa 8% down to 4%. I think the true central bank challenge is getting inflation from 4% down to 2.5%. I think that's where the real challenge is. That's where the degree of difficulty is. That's where the skill is going to come into play. And I think that last part is really the part that we need to start focusing on now.
So looking at 2023 and assuming the RBA continues this increase that isn't going to tame inflation, can you see inflation really becoming entrenched, at around 4%? Or, is that a likely scenario?
Oh well, look, I think when you look at how inflation has evolved here domestically, at least, so I'll focus on the RBA and Australia specifically. I look at that, and we've certainly moved. I think that transition is well underway, going from a goods based inflation to a services based inflation. We are a market services type of economy. We don't really make a lot of productive goods in the world. We really are a services economy. And what that ultimately means, I think, from an inflation perspective, is that the inflation is starting to gravitate towards that services area. Obviously, very high labour component, but what that also means is that it's going to be more sticky, and it's going to start to come through in the core numbers and what I call the super core numbers, which are going into another layer of stickiness. And I think it's just going to be really hard to ratchet that out of the system. So the inflation outlook for mine really means that we're going to be lucky to get back to target, probably even by the midpoint of 2024. I think it's going to be hard to do. It's not going to be easy, and it's going to require some ingenuity from central banks to do it.
So given that context, what strategies are you using in your funds to try and increase returns over and above inflation?
Yeah, well, I think this is where you've got to be incredibly creative. I almost think 2022 was a little bit easier because the direction of interest rates was very easy. It was very simple for everyone to see that rates had to go up. Sure, it was a little bit belated, and obviously we all know what central banks ended up doing around the middle part of last year. But it was quite binary, the decision making process. Yes, the question was more around how much and quantities and those sorts of things. But everyone broadly, I think, came to accept that that this wasn't a transitory phenomenon. We had to do something on the central banking side. So I think for 2022. Look, for us, we're a little bit different. We're an absolute return manager, so we need to go where we need to go in order to deliver absolute returns to our investors. So that means we're not benchmark aware. We benchmark ourselves against an RBA cash rate. If we've got to go to a particular part of the world into a particular strategy in order to achieve the risk adjusted return that we need, that we've promised our investors, or that we guide our investors to, I should say, we've got to go there. And that has meant that we have typically been more offshore, more global in the way that we do things. I can't sit here hand on heart and say that Australia, with 2.5% of global GDP, is where we generate 100% of our alpha from. That just doesn't make any sense. Australia is a very closed-in market. It's predominantly financial dominated. There's not a lot of diversification, and it's swamped now by some of the major funds, and really the volatility in the space doesn't really throw up enough opportunities to generate a sufficient rate of return in our view. Hence the reason we believe global opportunities is really where, I guess, the more significant alpha is going to come from. So that is certainly what drove our performance over 2022. We were very constructive on the asset class, I think, particularly around August, when we started to see spreads in Europe blowing out to around, pandemic highs, 700 basis points in crossover. I mean, that is scorched earth scenario that we saw. And the thing I've been saying to people is that over 2022 and probably 2021, we have had a full economic cycle. And I think that's often lost on people. When you get out and you speak to people, people say, it'd be good to see, how you go over an economic cycle. And you go, well, guess what? We've pretty much had it. We've gone from a disinflationary environment to probably one of the highest types of inflation that we've seen in 40 years. And so everything has been condensed into such a short period, and that's really difficult for our asset class because we typically rely on running yields as a big contributor to performance. But when you have that abrupt, really aggressive type of shift that you've seen on the capital side, where bonds are losing money hand over fist, many of the benchmarks are down. Between 5 and 10%, and managers are down 5 to 10% in nominal terms. Nominal terms, that doesn't even take into account the 7.8% inflation. It's been an absolute bloodbath across our asset class, and so you've got to I think you've got to be nimble. You've got to be moving around the curves. Inflation is obviously a big focus for us, and the way in which you manage that is absolutely critically important, particularly throughout the G7 economy. So we're certainly very active there, and we're very active across the capital structure as well. Just making sure that we didn't step on any landmines throughout 2022, because I think it would have been very easy to do, and we've certainly seen that. But as for 2023, I think many of the themes. Many of the themes will carry forward. It will just be more nuanced. So as we look into 2023, I don't think any of these large themes are going to go away. We're still going to have inflation. We're still going to have high term structures. We're still going to have a lot of the same types of conversations about budget deficits, wars. All of these sorts of things I think are going to be with us for probably the next 12 months at least. But where it changes, in my view, is it becomes more nuanced. It's not as clear cut, and therefore it's going to probably be more an oscillating type of story, as opposed to these very clear narratives that have come through. And so how you build out those themes and how you manage through those themes, I think, is going to be much more testing in 2023.
Absolutely. So where do you see the balance of risk now, and what do you think are the major risks going forward?
Look, I think the major risks are probably, there's so many areas which you can point to that could flare up. At the moment you've got the US debt ceiling. You've got China. They're opening up. That could be an upside risk. That could ultimately be something that we're not factoring in here for the RBA. I mean, the RBA has 1.4% GDP growth priced in, which I think is a little bit high. But our major trading partners have GDP growth, and when I say major trading partners, I'm talking China, Japan, US, and Europe. They're up around 3% on average, I think, roughly. So we've got good underpinnings to potentially stop us going into recession. But we do have to be very mindful of the fact that we are around that 1 to 1.4% GDP for 2023, or will be. And that just means the margin for error is a lot less in a commodity-based economy as well. So that's really important to remember, is that we generate so much of our growth from the commodity story. And when you've got volatile price swings in iron ore and these sorts of things, it means your degree of error is very small. If you had a non-commodity-based economy, you tend to get much more stability in your GDP, and therefore the forecast errors are a lot less. We don't have that luxury. So we could easily, the risks are high for an economy like ours in terms of going into recession, and we certainly see that volatility in our credit markets versus other credit markets such as the US, and we also see it in our equity markets as well. I think Italian politics is always another risk that's out there. You can never write that off. That's a constant circus. You've got antitrust issues with big tech. You've got Indian growth. Everyone's looking to India now as the baton change from China onto the next growth engine. And then you've got obviously the ever looming risks of recession in the US and Europe, which are obviously receding as we sit here and speak today. But I wouldn't be ruling out that narrative coming back as well. And I don't think we're going to see interest cuts in 2023. I think I'd be pretty surprised to see that unless we had some type of left field event. But as I said before, I don't see inflation coming down to justify that. So I think that's sort of where I land on a lot of those things. European warmer winter, that could be something, and again an upside surprise. Could be a good thing for energy markets and gas reserves and these sorts of things. But for me, the resilience of the consumer has been, again, another upside risk. I mean, the consumer has been staunch in front of, a barrage of assault, really. It's had tighter fiscal, had, interest rates thrown at it. We all know about the mortgage cliff that's coming to hit the consumer soon as well. But despite all of those threats, it's still, people are still spending, and I sort of compare it to the violinists on the Titanic a little bit. Are people just making the most of what's left? And it could well be one of those sorts of things.
That's so funny, Christian. How do you see the US yield curve versus the Australian yield curve and what they're telling us at the moment?
Yeah, I think the yield curve is really interesting because I've sort of compared it to dominoes, is that every day you seem to look at the yield curve and it just seems to be that there's one part on the yield curve that seems to sit positive to either the Fed funds rate or the RBA cash rate, and that's really in that 1 year swap part, so the 3-month 1 year, that sort of area. That's sitting positive, but the rest of it's all sort of starting to go slightly inverted, if not totally inverted, like what you're seeing in the US. So that's really been, I think, the standout transition across the curve throughout 2022 is we've now gone to this really inverse world, and it doesn't seem to be wanting to steepen up anytime soon. So the market is absolutely convinced that central banks are going to have to go into reverse and ultimately correct for the overcorrection that they've done on the monetary policy tools. But again, I think that could be a little bit optimistic in terms of the timing. It's pretty aggressive. And when I look at the inflation markets as a proxy for that way of thinking, I look at the break-even curve and I look at ZCS markets and these sorts of things. And, you know, they are pricing a Goldilocks scenario. And I'm just not convinced on that. At least I think the degrees of risks around those things are still elevated. Yes, inflation volatility has come down, and I think it's come down more because we've moved into a services-based inflation as opposed to a supply chain type of disruption. So the volatility is coming down, and it warrants less vol in those markets. But nevertheless, it still feels like the rose-coloured glasses are on in relation to inflation. I'm just not convinced on that just yet.
It certainly seems like the share market thinks we're done and dusted and rates are coming down from here. Doesn't sound like you agree with that view.
Look, I think, I probably wouldn't be as optimistic as what the equity market is. In fact, I probably would be out of a job in our asset class if I thought like equity managers did. Our job is to be permanently negative, Liz. You should know that.
Oh, I sure do. Christian Baylis, thank you so much for joining us today. Just before we go, can you talk us through your funds a little bit? Because, I mean, your returns, all three funds, more than double digits for the last year, all investment grade, an outstanding result. You've won awards, international awards as well for your management. I mean, big congratulations. You've worked so hard. Just talk us through the funds. It'd be great.
Yeah. So, as you know, Liz, we have minimum thresholds and return targets that we seek as objectives within the funds. We also tend to be more risk-based in the way that we manage our funds. So we've got 3 different funds at different points on the risk curve, and we always like to tell people to be in our higher vol fund or our alternatives product. You need to be a consenting adult, but pleasingly that fund has returned 14.85% since inception, up 14% over the year, which was obviously a very pleasing outcome. And again, that was just really came down to the build out of the themes that we've previously been talking about, how we implemented that. We're in the right parts of the world, fortunately, and in the right parts of the credit markets and the interest rate curves. And then in our mid-range fund, we were very fortunate again there to have returns of around about 12% in that particular fund, and then in our lower risk fund, similarly, we had decent returns there. So, it was a good year. High volatility, that tends to suit our strategy. We don't like condensed contractionary type of markets where you've got nothing going on. And I guess there was just a smorgasbord of opportunities that got thrown up in 2022 in large part. Due to central bank action and the like. There was certainly many events over the year which really allowed you to make the most of a pretty poor market. So that there was, and I guess you've got to be in a position to grab those opportunities, and certainly, we'd hope that over 2023 we get the same type of vol. Not that I would expect that, but I think, as I said, I think 2023 will be a lot harder.
Thank you so much for joining us today. I really enjoy our chats. I always learn a lot from you, Christian, and I'm hoping we can speak again in about a year's time.
No worries, Liz. Thanks so much for having me again. Cheers.
Thank you for joining us this week on Fixated, the Fixed Income Podcast. Still hungry for more fixed income news, views and education? Then visit fixedincomenews.com.au and don't forget to subscribe to our newsletter to have the latest news delivered right to your inbox. Thanks again for joining us. I'm Elizabeth Moran, and we'll see you next episode on Fixated, the Fixed Income Podcast.